On the chart that we're looking at this morning, it's the calm amongst the chaos. It's been 2 months since we have had a 1 full percentage point move on the S&P 500. Incredibly tight ranges and matching the longest streak of the current bull market. Joining us now is Jonathan Golub. He's RBC Chief US Market Strategist. Jonathan, remarkably calm if you're looking at that chart right there. When you wake up and you see that chart, does that make any difference to the way you see the markets in any way, shape or form?
It makes a huge difference. First of all, if you were a trader, you'd be looking at the VIX rather than, how long it's been since we've had a 1% move. But when you have low vol, stock valuations go higher. And so I think that this really is something that supports this up market. And what's so interesting is everybody thought that Trump would be the guy that would send volatility off the charts by his 2 o'clock in the morning tweets. And what you're actually seeing is the market is seeing this in a bizarre way as a very calming backdrop. So
you've been looking lately, and your latest research report really digs into it, is where to go. Do you go to the high dividend yielders or do you go to the low volatility stocks? And typically in a rising rate environment, a lot of people I think would sit around and say, you know what, I want to avoid the high dividend yielders at this point. That's not the story for you though.
No, and if you step back and look at what the big picture here, it's really a reflation story. The economy is doing well. We have unemployment well under 5%, has been under 5% for a year. Interest rates are up over 110 basis points, over 1.1% since mid-year. And that, what people would think is that that's a really bad environment for dividend-yielding stocks, but that's not what's happening at all. Dividend-yielding stocks are actually outperforming the market, but what's getting beaten up is safety stocks. Those, utilities and REITs and staples that seem super secure. When you have a reflating market, you actually want to rotate towards junkier, lower quality names, and that's kind of an interesting story.
Well, Jonathan, let's get into that, because whenever anyone turns around and says to me, look at this high yielding stock and buy it because it's such a big dividend yield, and I would say, well, clearly the price has either got to adjust or the divvy is going to get cut. But your message this morning is buy junk. How hard is it to sell that message?
It's interesting. If you talk to the hedge fund community, they realize that you're buying stocks, not companies, and that you have to look at them separately. Very often, though, individuals, when they buy for their own portfolios, they look at these and they fall in love with the company themselves, and they want that stability. And there are times when stability is the play, and there are times that, like now, that I think that it's not the right time for stability.
What kind of yield do you have to see to get compensated for taking that kind of risk?
Well, I don't know if it's a yield story per se, but if you look right now, a lot of the higher yielding stocks are in the energy sector, or even industrials and consumer discretionary. Basically, mature industries, old tech companies have reasonably high dividend yields. And yet they're more economic, and I don't say they're junky because that's probably not the right way to describe them. They're more economically sensitive, and as a result, they tend to jump more when the economy improves, and that's what we're seeing is an improvement in economy.
But what's really interesting is that the consumer stocks have actually stopped reflating. Like, yes, we have a better jobs picture. I mean, wage growth in the last jobs data report wasn't great, but inflation expectations are pricing higher. But consumer stocks, look at Under Armour, for example, Ralph Lauren, Hanes Brands is getting really beaten up. So the stock's not keeping up with the overall macro picture. So how do you square that?
Well, so Alex, if you ask me, would I be buying those kind of names? Not this, I'm not an analyst on names,
sure,
but over the next 12 months, I would absolutely be buying those names, because here's what you have. Wages are going up. The unemployment rate, because it's so low right now, confidence in people in their ability to find a job if they were to get laid off or if they just don't like their boss is rising. I think you're going to see even in housing that people, even with rising interest rates, they're going to say, okay, a house costs a little bit more, but I'm confident in my job and I'm getting a raise. So as much as they haven't been winners in the last perhaps few weeks, I would be pretty confident in those kind of names.
Wouldn't it be great, David, if the quits rate was that forensic and you knew who quit based on them not liking their boss?
Well, it's a great job stat.
It's true.
No,
when
it's
you see people voluntarily leaving their job,
absolutely,
it's a massive sign about confidence. And we have seen that statistic rising recently because confidence is so high in the job market.